Today in this video, we are going to explain the central bank and its function. In every country, there is one apex institution which acts as the leader of the money market. It supervises, regulates, and controls the activities of commercial banks and other financial institutions. Such an institution is called as the central bank of the country. A central bank is so called because it occupies a central or highest position in the monetary and banking structure of a country. In India, Reserve Bank of India is the central bank of the country. Reserve Bank of India was established in 1st April 1935 under Reserve Bank of India Act passed in 1934. So it was established in 1935, 1st April 1935. So a central bank is an apex institution, that is principal, the highest authority, which operates, controls, directs and regulates the monetary and banking structure of a country. A central bank is an independent national authority that conducts monetary policy, regulates banks, and provides financial services, including economic research. Its goals are to stabilize the nation's currency, to keep unemployment low, and it prevents inflation. From this if we see the difference between the central bank and the commercial bank, we have certain point of their distinction. Central bank and commercial banks both constitute the banking structure of a country. But a central bank differs from a commercial bank in many respects, such as the central bank is the apex institution of the entire monetary and banking structure of the country. On the other hand, a commercial bank is mainly a unit or a part of the banking structure of the country. Second, every country has only one central bank, while a country has several commercial banks and their member goes on increasing with the development of the country. Third, a commercial bank is operated for profits, but the central bank is set up basically for public interest rather than for profit. It stabilizes the nation's currency, to keep unemployment rate low, and to prevent inflation. Central bank does not directly deals with the public. On the other hand, a commercial bank deals directly with the public. It accepts deposits from the public and gives loans to the public. Next, the central bank enjoys the monopoly power to issue currency notes, while commercial banks are not authorized to undertake this function. Commercial bank has no right to issue currency notes. The central bank controls credit, whereas commercial banks create credit. Finally, a central bank acts as an agent and a banker to the government. It also renders advice to the central government on monetary and fiscal matters. The commercial banks do not perform such functions for the government. So these are the points of difference between the central bank and the commercial banks of a country. Now let us know the functions of central bank. Bank of issue. It is the primary and very important function of a central bank. Nowadays, central bank is in every country has been given the sole right of issue currency notes except 1 rupee notes which are issued by the Ministry of Finance. This 1 rupee note is considered as coin, and coins are not issued by the RBI. 1 rupee note is considered as coins, and this is issued by the Ministry of Finance. But all currency notes other than 1 rupee issued by the central bank. This function gets such an importance that the central bank has come to be known as a bank of issue. The central bank keeps three main considerations regarding issue of notes. Number one, uniformity. Number two, elasticity, that is, amount according to the need of money. And safety. Government's banker, agent, and advisor. As banker to the government, the central bank makes and receives payment on behalf of the government, central government as well as the state government. It helps the government with the short-term loans and advances in times of difficulty. As an agent to the government, the central bank conducts sale and purchase of government securities and also manages the national debt as well as foreign debt. The central bank also acts as an advisor to the government, especially on monetary, banking, and financial matters. Custodian of cash reserve of commercial banks. All commercial banks keep a part of their cash balances as deposits with the central bank of the country. Thus, the central bank acts as the custodian of these reserves. It is because of this function that a central bank is called a banker's bank. Custodian of international currency or nation's reserve of international currency. The central bank is the custodian of the country's stock of gold and international currencies. All receipts and payments in foreign exchange are made by the central bank. Through this function, the central bank maintains the rate of exchange and manages exchange control. Lender of the last resort. As commercial banks lend to the individuals, the central bank lends to the commercial banks in times of unanticipated emergencies. Thus, the central bank assumes the responsibility of meeting directly or indirectly all the reasonable demands for funds by commercial banks in times of difficulty and crisis. A commercial bank can borrow from the central bank against eligible securities. It is mainly due to the rediscounting function that a central bank is often called as a banker's bank. That is, short-term loan is provided. When there is no other way to the commercial banks to meet the demand of the depositors, because of shortage of fund or cash. That time the central bank helps the commercial bank, and because of this it is called the lender of the last resort. Bank of central clearance, settlement and transfer. Because central bank keeps the cash balances of all commercial banks, it is easier for member banks to adjust their claims against each other in the books of central bank. This system of clearing agreements facilitates transfer of funds quickly, safely and at low cost. Controller of credit or controller of money supply. Controlling of money supply and credit is the most important function of the central bank. Through this function, the central bank attempts to influence and control the volume of bank credit and economic activity in the country. Central bank can control inflationary and deflationary situations in the economy through various credit control measures. Credit control measures can broadly be categorized into two: quantitative credit control measures and qualitative credit control measures. So let us know these two methods of controlling credits. Quantitative method of monetary policy includes those instruments which focus on the overall supply of the money. And it includes bank rate, that is two policy rates. Bank rate. What is bank rate? Bank rate is the rate charged on the loans offered by the central bank to the commercial banks without any collateral. It is increased at the time of inflation to reduce the money supply in the economy and vice versa. Repo rate. This bank rate is also known as the discounting rate. Repo rate is the rate charged on the secured loans offered by the central bank to the commercial banks that includes collateral. It is increased at the time of inflation to reduce the money supply in the economy, and it is decreased at the time of deflation to increase the money supply. Two policy ratios. Statutory liquidity ratio. It refers to the liquid assets that the commercial banks must hold on daily basis as a percentage of their total deposit. So it is the minimum amount that every commercial banks required to keep in the form of liquid assets to meet the demand of the depositors. SLR is determined by the central bank and is a legal requirement to be fulfilled by the commercial banks. It is increased at the time of inflation to reduce the money supply in the economy and vice versa. So this money is retained by the commercial banks. Cash reserve ratio. Another part of the policy ratio is the cash reserve ratio. These are two variable reserve ratios called, or legal reserve ratios. Cash reserve ratios refers to the proportion of total deposits of the commercial banks which they must have to keep as cash reserves with the central bank. So this is with the central bank and this is with the commercial banks. The ratio is fixed by the central bank and is varied from time to time to control the supply of money in the economy, depending upon the prevailing situation of inflation or deflation. During the inflation, it increases CRR, and during the deflation, it decreases the CRR. Open market operation, OMO, is a monetary policy by the central bank in which the bank deals in the sale and purchase of securities in the open market to control the money supply. By selling the securities, the central bank soaks liquidity from the economy and by buying the securities, the central bank releases liquidity. Now, quantitative methods of monetary policy includes those instruments which focus on the selected sectors, not the entire quantitative, the entire total volume, but it is the selected sectors of the economy. Margin requirements. Margin requirement refers to the difference between the current value of the security offered for loan, called collateral, and the value of loan granted. So it is the difference between the amount of loan and the value of security. It is a qualitative method of credit control adopted by the central bank in order to stabilize the economy from inflation or deflation. So margin requirement is increased at the time of inflation, and margin requirement is decreased at the time of deflation, or when the economy wants to increase the money supply, it decreases the margin requirements. Rationing of credit. Rationing of credit refers to a fixation of credit quotas for different business activities which is introduced when the flow of credits is to be checked, particularly for speculative activities in the economy. Moral suasion. The central bank makes the member bank agree through persuasion or pressure to follow its directives, which is generally not ignored by the member banks. The banks are advised to restrict the flow of credit during inflation and be liberal in lending during deflation. That's all in this video. Thank you.